Hello and welcome to the Investor's Guide to Asia, where we explore the most important investment stories from across the region. I'm Stuart Rumble, Head of Investment Directing for Asia Pacific at Fidelity International.
And my name is Taoshi Wang, Portfolio Manager at Multi-Asset Team. On today's episode, will 2026 be the year for India?
The structural story is obviously very well known, isn't it? There's a young, large population, rising income, low product and service penetration. So the long-term potential is there, and even after a decade of strong growth, the long-term investment case looks very compelling.
Yeah, but it's always, as investors, we're always concerned about turning the long-term potential into immediate gains.
To explore that question and obviously a lot more, we're delighted to be joined by Nitin Mathur, who's the Investment Director for Indian Equities and Emerging Market Equities at Fidelity.
Thank you, Stuart, for having me on the podcast.
Welcome. Happy New Year.
Thank you so much.
2025 turned out to be India's softest period of post-COVID GDP growth due to a combination of different factors, weaker domestic demand. We obviously had changes in the trade relationship, particularly with the US. Perhaps just to open us up in one sentence, Nitin, will 2026 be better?
We do hope so. I think the government has been very proactive in doing a lot of policy steps. And the market has been, as you said, in an economic slowdown. I think 2026 seems to be a year where we can see an uptick in the markets. But I think it's important for India to be considered as a long-term investment opportunity and not a one-year opportunity. I think 3 to 5 years of view on India is something that we should be looking at.
So less about sort of sharp immediate rebound and more about perhaps a turning in the cycle, which neatly sets us up for a view of kind of what didn't quite go so well in 2025. Maybe starting with the external picture, listen, much of the story, I guess, centered around tariffs and the broader conditions geopolitically. How significant were these issues and impact on India's economy and obviously also the equity market over the year?
I think they were significant to an extent. I think if the key things that we saw from the US was that they imposed 50% tariffs on India, 25% tariff and 25% penalty for buying Russian oil. There was also $100,000 fees on new H-1B visas, which also kind of spooked the markets. I think if you look at what happened in the real economy, India has a big exposure to the US in terms of goods and services exports. On the other hand, from a US perspective, India is not big. If you break it down, 20% of India's goods exports go to the US, 50% of India's services exports go to the US. If we look at the goods exports, then the big buckets are your generic drugs, your textiles, and gems and jewelry. In generic drugs, there was an exemption, so they did not. There's no tariff on generic drugs, so that was not impacted. But if you look at the textiles and the gems and jewelry sector, that's where the impact was. And these are also areas where a lot of the medium and small enterprises work. So the impact was more on the jobs, on wages. Those are the things which kind of impact the real economy. Then if you look at it from a services perspective, I think it was this H-1B visa thing had an impact on sentiments. But if you look at the real impact on these companies, we didn't see a large impact.
Taking a step back, I mean, there has been this concept of, China plus one model for the global sort of economy to diversify away from China being such a concentrated source of supply for, almost everything. Does that change, the perception? India was obviously viewed as a prime candidate to fill that role. What's your perception of India's potential in that role?
I think it's important because, we are seeing this diversification out of China on manufacturing. But I think India is only one part of the whole picture. This diversification of supply chain, which has accelerated in the recent years, a lot of countries are actually benefiting from that, and India is only one of them. Also, the fact that this is a long-term theme, you're developing your own supply chains and a share into the global manufacturing is something which takes a long time. 10 years, 5 years, it'll be a long-term kind of a theme. And it depends on what countries are able to, put the right policies in place to be able to do that. I mean, India has been benefiting, but I think there's still a lot more to do in India to kind of boost its manufacturing sector. And manufacturing is something we'll talk about obviously later on, but that's something where India is still kind of lagging behind a lot of other countries in the region.
Feel like last year some of the external factors probably grabbed the headlines, but they overshadowed somewhat what's happening internally. If we just turn to that for a second, obviously we had some softness in consumption, particularly pressures in the lower income households, rural parts of India. What were the sort of main internal drivers for the weaker year last year, Nitin?
I mean, I think if you look at it slightly from a historical perspective, post-COVID, what we saw in India was a K-shaped recovery in consumption. That was because a lot of the benefits of the initial opening up of the economy actually went to the more wealthy class of consumers. They saw, we saw urban wages growth higher. The wealth impact of increase in asset prices also went to them. Services sector did very well, which employs a lot of the skilled labor. So a lot of that actually meant that the upper middle class was doing very well, and that consumption, the premium housing, the premium cars, premium two-wheelers, those are the areas which are benefiting and growing much faster, while the mass market actually was not doing as well. What has happened more recently is that we have seen after a few years of very strong growth, the consumption in the upper middle class, the premium segment, has actually started to give back a little bit. And on the other hand, with more government policies, we are seeing a little bit of an uptick in the consumption in the mass market. So I think the economy is going through a period of rebalancing, and that's essentially what probably will be the key focus in going into the next year.
I mean, looking at just the big picture numbers, India's inflation numbers are low and the government's funding cost is relatively manageable. Can we reasonably expect, more accommodative policies, both from, I suppose, fiscal as well as the monetary front?
I think that's what is happening. So if you look at what the government is doing, and I think it's also to do with the democracy in India, where there's a feedback mechanism through votes. So the government, when they came back this time, they realized that they have to do a little bit more for the social sector. They came back with a lower majority. When this happened, they started to do a lot more for the mass market. So the first thing we saw was that they cut income taxes. So anybody earning 12 lakh rupees was exempt from paying tax. It used to be 7 lakh earlier. So that kind of helped a lot of the middle class consumption. Then more recently, we have seen goods and services taxes being rationalized. They reduced the number of buckets there. And the idea was to boost or give more concessions to the mass market segment. And then, as you said, monetary policies, inflation came down, so they were able to reduce interest rates. So the Reserve Bank of India has cut interest rates by 125 basis points in the last year or so. That has kind of led to a lot of monetary policy boost as well. So all that, if you add them up, and then there were a lot of cash transfers. India is digitizing, so they are able to transfer these subsidies directly to the households. All that kind of led to something like 1.5 to 1.6% of the GDP in terms of the total stimulus, monetary as well as fiscal stimulus. Plus, there have been some other things as well which have been done. So they have, for example, opened up a few sectors. They have opened up 100% foreign investment in insurance. Nuclear sector has been open to private sector. They have done some reforms on the labor side. 29 labor codes have been rationalized into 4 labor codes now. So that kind of helps with your simplification of tax regime. So a lot of these things have been done, but I think a lot more needs to be done as well, because India does need a lot of reforms on the capital, on land, a lot of other factors of production, which will then lead to manufacturing and exports of goods to come back to India.
Makes sense. Although funding costs are relatively lower, as you mentioned, Tausha, but the fiscal space is also somewhat limited. So all of this matters for confidence as well, and reforms, as you say, are important. These all explain the more near-term picture, Nitin, but what should investors pay attention to in the long term? We talked at the beginning about the structural story. What are the main features of that?
If you look at consumption, I mean, India is still less than $3,000 of per capita GDP, and a long way to go. This is where China was in 2006, 2007. You have your middle class. As this GDP per capita grows to 4,000, 5,000, your middle class should increase. So the number of middle class households are expected to increase from 200 million households now 2024 to around 300 million households. So 50% increase in the number of households. And then the penetration of goods and services in India is quite low. If you take the example of air conditioners, India is less than 10% penetration in terms of households. If you look at China or US or some of the other developed markets, that penetration is 90%, 100%. So there's a long way to go for these penetration of goods and services to increase in India. India still needs a lot of infrastructure. Government has been doing a lot of that infrastructure projects. If you look at the historical data, India doubled its capex spending before 2020 and 2020 to 2025. So 5 years now versus the previous 5 years, we have seen the capex spending double. Now we are seeing a slowdown there because the government wants to provide more room to the private sector to do it, and that's not happening. So that's the next segment of growth that we have to look at. And then finally, services is another one. So as I said, 55% of India's GDP is services. A lot of the skilled labor actually gets employed in the services sector. So that's where a lot of growth has been happening. I mean, India produces 2.5 million STEM graduates every year. These guys get employed in the services sector. We've seen a very strong growth in GCCs, Global Capability Centers in India. These are the guys who get employed there. They also go overseas like me, and then they remit back their earnings. So that whole services economy is a big part of Indian economy as well. So I think consumption, services, and capital formation, gross fixed capital formation are the 3 big buckets which we should be looking at.
Okay, thank you, Nitin. Before we delve into industries and markets in a little bit deeper, let's touch upon one of those larger areas of the Indian economy. Patrick Graham, producer, caught up with our tech portfolio manager, Terence Sai, on some of the latest developments in the IT services sector.
Terence, thanks very much for joining me today. You invest globally in tech companies. We're here today to talk about India's big IT services companies. How is the AI boom affecting them?
Well, maybe I'll first start with the narrative. And the narrative to date on AI has been largely negative. I think IT services kind of fall into the same category as software, where they're seen as AI losers or they're negatively impacted from AI. I think there's some truth to that in the beginning. AI is largely deflationary for India IT services, and our Indian analyst Sid has done a lot of work on this. So I'm leveraging a lot of his on the ground research, and I think in the beginning it was deflationary, but over time I think the market will realize that these AI will produce revenue opportunities for these IT services firm. Why are they deflationary? Obviously, AI automates a lot of tasks. A lot of the areas you need for coding, the areas you need for coding and other consulting services that you need a large labor force for could potentially be automated away. So I think that the narrative has been largely negative to date.
Okay, but do you think those companies have been oversold then? Is that the general vibe?
I think so. The market usually operates between fear and greed, and right now it's mostly on the fear spectrum. I think the way the Indian IT services companies, the value they provide, goes back to what I've said before for software, which is they have 10 to 15 years of history working with these companies. I think the number was 75% of the US Fortune 500 companies engage Indian IT services firms. And I think we shouldn't underestimate the amount of data and that working relationship and the know-how of these IT services firm. They've increasingly trying to productize their offerings. So I think the Indian IT services firm have also tried to pivot. I think once the market realizes these could be revenue generating opportunities, I think we've passed the worst of the deflationary period. I think it could be pretty interesting. Most of these stocks are trading near trough multiples because of how bad sentiment has been.
But they're also still highly cash generative, right? That's the general argument for them.
Definitely.
Terence, thanks very much.
Yep, thank you.
And that was Terence speaking to us from our London studio earlier. Nitin, how important are these IT services company to the overall India story?
I think it is important to understand that these are the companies which will be implementing a lot of this AI for enterprises. And they have been doing that in the past. I mean, if you look at the share of IT services, Indian IT services companies in the global IT services space, it has grown over time from 1-2%, 3% to 10-12% now. Despite all these technologies coming in, we have seen them increasing their share in the global services space.
So the ability to adapt regardless of what kind of technology.
Correct. And if you look at what is happening now, a lot of these hyperscalers are doing billions and of hundreds and billions of dollars of capex. The monetization of this capex needs to be done either, it has to happen through more adoption of IT. If you look at enterprises, it is very difficult for them to do it on their own. They don't know how to do the AI implementation in their companies. I think a lot of that is going to be done by the IT services companies in India. So I think that will also monetize a lot of this capex which is happening.
This economic structure also shows up in the equity market, doesn't it? It's in the services sectors, financials, IT, consumer, they kind of dominate the local domestic market. What is the implications of that for investors seeking growth? And I kind of think of this in terms of how does it shape the opportunity set for investors, both looking at India in isolation, but also in comparison to other emerging markets?
Sure. I mean, if you look at it from the perspective of the structure of the market in India, the big parts of the market are your banks, your financials. They are the biggest part, 30% of India's MSCI India. Then you have sectors like consumer discretionary, another 17% of the index, consumer discretionaries plus consumer staples. Then you have your IT services sector, your industrials, energy, materials, building, making up the rest of it. But a lot of these sectors are all traditional economy sectors. IT services, as we were talking about earlier, is around 10-12% of MSCI India. But the domination is of the traditional economy sectors. I think that is going to change as we go forward. And it's already started to happen. And that's where a lot of the new opportunities are going to come.
A lot of these new opportunities, the market generally is quite well known for trading at a valuation premium. So if you look at things like the PE ratio, on average, that tends to be higher for India relative to other emerging markets, for example. Why is that? Is that justified by fundamentals? And are there some risks around that investors should pay attention to?
So it's not cheap, but it's not very expensive compared to emerging markets. If you look at it from a historical perspective, India is not cheap versus its own history. So I think we still need to be careful when we are investing in the Indian market. You have to be very stock selective. But the reason you can argue is that the Indian market actually gives you a higher return on equity. That can be one of the reasons why you get higher valuations in India. The good quality companies are present in the MSCI India index, and that kind of leads to higher return on equity on India.
There has been some pretty significant flow back into some of the other major EM economies, and China has attracted a lot of attention. Korea has been on a stellar year. Has that distracted flow from India? And it's seeing that some of these markets certainly started with a much lower valuation.
That's true. I think, if we look at it from a global fund flows perspective, India has seen outflows from foreign institutional investors. In the last year, 2025, I think we saw around $20 billion US dollars of outflows from Indian equity market. But then the domestic institutional investors actually invested $90 billion US dollars in the Indian equity market, which kind of supported a lot of this. So as we were talking earlier, the valuations in India have actually not come down. The market has not derated. The earnings growth has also come down. The market has actually corrected in line with earnings correction. There's no derating in the market. So I think from a global perspective, we have seen outflows from India. If the market kind of corrects or things start to turn, especially in the AI space, there can be opportunities for a market like India to get more inflows.
And if we saw a lot of inflows, how deep is the Indian market to be able to absorb those? I'm particularly thinking about this kind of small mid-cap space here, which often gets a lot of attention as well.
The small and mid-cap space, liquidity is tough, especially in a bad market cycle. You can actually see liquidity drying up quite fast. But I think the overall market is improving in terms of both its breadth as well as depth. We were talking about earlier in terms of domestic institutional investors investing $90 billion in the Indian equity market. If you look at last 2 years, I think it is around $150 billion US dollars. So it has kind of the increase in the participation of domestic institutional investors has deepened the market. In terms of breadth, if you look at the last couple of years, we have seen a lot of IPOs in India. $43 billion US dollars raised through IPOs in the last 2 years, $22 billion in 2025. So a lot of IPOs have actually happened. And again, as we were talking earlier, traditionally, the Indian market has been dominated by old economies kind of sectors. And a lot of these new IPOs are in the new economy sectors. And finally, we have seen 2 companies join the MSCI India index in the new economy segments. So one is Paytm, which is a digital payments company, and the other one is Eternal, which is your food delivery company. Both of them are 30-40 basis points each of the MSCI India index. So still very low. Very small in terms of the whole MSCI India. But a lot of new companies have actually got listed in the market. So things like, if you look at it from the last couple of years, Swiggy is one, which is another food delivery company. Then more recently, we've seen IPOs from Meesho, which is like a PDD or a Shopee of India, e-commerce company, low ticket kind of things. They have got listed in the equity market. Other companies like Urban Company, which is like your handyman. You can book them online, and they come over to do your AC cleaning or your house cleaning and those kind of things. So very new kind of business models coming up and getting listed in the market, which is providing a lot of options, new opportunities for active investors to start investing in these companies at the right price. Probably not in the IPO, but later on, as they become more, reasonably valued, to be able to invest.
This is the thing that's really fascinating to me, as well as more of the economy gets capitalized in financial markets. It's obviously going to see an evolution in the shape of the equity market, throwing up opportunities as well. Obviously, as you say, you need to still be selective of those. So let's get to the nub of the issue, Nitin. What should we be looking at, or what investors should be looking at the moment?
I think financials is one, IT services is another, healthcare is another one, which we believe from a risk reward perspective is a good opportunity. And then selectively in the consumer discretionary space, we are finding opportunities. I think if you look at it from the last cycle versus this cycle, I think the drivers of the next cycle probably would be these sectors, compared to the last cycle where we saw a lot of industrials companies, power sector, utilities, real estate. So that the leaders of the next rally probably would be these sectors.
Can we dive in a little bit more into financials? Financials usually sort of a health barometer of the overall economy, and usually, typically a very large part of the EM country index. Can you explain a little bit more, why financials haven't done so well, and, what are we looking at into the future?
No, certainly. I think in the last couple of years, we have seen the banking sector underperform. There are a few reasons for that. So if you look at the loan growth in India, it has come down from around 15% to 10%. So in addition to your reduction in loan growth, the compression in net margins has meant that the earnings growth has actually come down in the last 2 years, which has been a key driver for their underperformance. But I think this should stabilize now with interest rates coming down to 5.25%. And also the net interest margin compression, that pressure should ease as well. So these companies should be able to provide you, provide you a kind of an early double-digit kind of return, earnings growth. In terms of valuations, they are actually trading 20% lower than MSCI India index. They always used to trade in line with MSCI India. So both from a valuation perspective as well as from a fundamental perspective, I think they are well set for a recovery, or at least creating a bottom from here.
And to reference your point earlier, if we were to expect more expansionary policies from the authorities, then certainly that volume story, that overall loan growth, which tend to gear to overall macroeconomic growth, should also pick up as well.
Certainly, and I think these banks are also structural growth stories. So they benefit from financial inclusion. They benefit also because they are taking market share from public sector companies, because we invest typically in private sector banks. So these private sector banks benefit from, as you said, your structural growth, market share gains, and then if their earnings growth starts to improve, I think they are well set for a recovery from here.
What about gold? Gold has been very top of mind over the last, I would say, year or so. And gold is culturally significant in India and traditionally a sort of a storage of personal wealth.
Yes, no, that's true. I think gold is important. It's very important for Indians. Not too many investment opportunities. There are a few companies like Tanishq, which is a gold retailer, a couple of other retailers of gold as well. But I think it is important from a wealth perspective as well. The rise in prices of gold means, we were talking earlier about the wealth effect of increase in property prices and increase in equity markets. That does not percolate to the mass market. The ownership of gold is much more diversified. So the mass market people, generally also have gold. So an increase in the price of gold actually has a wealth effect on the mass market as well. Is much more broader. And sometimes they are also able to monetize that by taking gold loans. So some of the non-banking financials companies, they provide loan against gold. So, your small ticket loans, you mortgage your gold for that. So I think the impact of a rise in gold price happens much more broadly in the Indian economy.
Okay, time to break off and look at Asia's other largest economy and the outlook for China in 2026. Earlier, we caught up with Pei Chin Liu.
Well, there are three things that I'm watching for going into 2026. As we all know that in 2025, export outperformance was the dominating theme of China's growth in terms of structure. So in turning into 2026, I'm watchful for the normalization of China's export growth as the top on the radar. Secondly, I'm also watching for the property sector. We know that it's continued to slow down for another year, but instead of focusing on the degree of decline in the property sector in 2026, the focus has pretty much turned into when and how the property sector is going to stabilize and its associated impact on household confidence, on the wealth impact of households, as well as the broader consumption picture. And last but not least, we know that China is gearing in for a productivity-driven growth with its investments on manufacturing upgrading, industrial sector upgrading. That impact on employment is something I'm watching out for very closely as well. We know that youth unemployment has been an issue from both cyclical and structural perspective for the last few years. So we're heading to 2026 to see if that is going to improve or deteriorate with the productivity gain coming from the new industries. I think exports will still likely to be a key engine of growth in China, as China has cemented its role as a key player of global manufacturing supply chain. But that angle of contribution will likely to be slightly different in 2026, as we all know that China has been pivoting into domestic demand as a key lever for growth. So in terms of GDP composition perspective, I think exports perhaps contribute slightly less in terms of GDP growth as the headline growth moderates, but domestic demand remains largely stable as a contributor to growth. Well, I think the renminbi appreciation that we have been witnessing towards the end of 2025, which is continuing at this moment, is perhaps driven by three key factors. Firstly, the trade surplus has been larger, hitting 1 trillion last year, and that is leading to more exporters' conversion, driving the strength of renminbi. And secondly, a weak dollar expectations at large. And lastly, I think the stabilization of China's asset market performance is also easing the capital outflow pressures, or in other words, or even having some inflows in terms of its capital account. So overall, I think renminbi appreciation is likely to continue in 2026. It's hard to see a target level that the policymakers is eyeing for, but I think definitely the pace and dynamics appreciation is on top of their mind, and the gradual appreciation is perhaps still preferred by the policymakers.
And that was Pei Chen speaking with us from the Singapore studio. The Chinese and the Indian economy are so interesting. They're both so vast, so much history, so many great talents. But one thing is so different is the demographic. And there's nothing you can change in the near term about demographic. And I feel like that is something that truly deeply anchors India's long-term growth trajectory.
I think the interesting thing is the contrast as well. We've got China managing a transition as well, a long-term transition. Their exports are still important, but perhaps, as Pei Chen says, a slightly lower contribution expected for next year while consumption starts to come back. And then India is different, isn't it? Because consumption is already dominant while they're trying to focus on building manufacturing capacity and growing exports.
And if the country manages to export more India-made iPhones, we probably should see that net export component of the GDP pick up.
Okay, so summing up today, I think the thing for me was the fact that the India growth story in the long term is very much still intact. Younger population, rising consumption, formalization of the economy, as you mentioned, creates this great broad runway for growth into the future. But at the same time, this softness that we saw last year and the policy shifts, hopefully highlighting the fact that you have to be selective about the entry point with this market. And of course, it always pays to be selective and focus on fundamentals as an investor in the equity market.
I really like the multiple layers of growth drivers that we touched upon. There's the broader sort of macroeconomic growth, there's the penetration of different goods and services into a rising middle class story, and there's the, a market share grab of high quality competitive companies from maybe some of their older and more stale competitors. So I think all of these things can really sort of accumulate and add on top of each other.
Listen, thank you so much for joining us. Unfortunately, that's all we have time for this month. So thank you once again to Nitin, Pei-Chin Liu, Terence Tsai for sharing their thoughts.
You can find out more about what we talked about today from fidelityinternational.com or your local Fidelity website. If you're interested in today's episode, please do share and subscribe. The producer today was Dan Tham with support from Patrick Graham, Judy Chen, Tommy Su, and Keith Trum. The managing editor is Seth Morton Clark. From me and from all of us at Fidelity, goodbye.